Welcome to our webinar for June month. As usual, we're going to start in America. In the last confidential report a month ago, when the S&P 500 was at 4167, we said that a correction was due. And of course, we watched it unfold. Let me show you that on the screen here. Right, so here you can see that correction. You can see it was a 4% correction in the end. And it looks like it is another mini correction because it's just about to break up to a new record high. If I go back about a year, or even a little bit further, you can see there's the COVID-19 V bottom, and there have been 7 of these mini corrections over the last year or so since the COVID-19 pandemic. This is obviously not the major correction which we predicted, but rather another mini correction. But we still believe that a major correction of between 10 and 20% is likely to occur, just because in technical analysis that is almost inevitable. You have a period of bullishness followed by a correction in any bull trend, and we haven't had a major correction for some time. If we look at the US economy, you can see that US GDP was revised to 6.4% growth in the first quarter. That's upwards. And the predictions for the second quarter average out at about 9%. In other words, they're expecting GDP to grow at the pace of 9% per annum in the second quarter. And some economists are talking about over 10%. Jobless claims in the last 14 months have fallen to their lowest levels. Biden has proposed a $6 trillion budget to imagine and reinvent the U.S. economy, involving a massive infrastructure build program. Of course, that budget has to pass through Congress, so it'll probably get whittled down somewhat. Also in the previous confidential report, we mentioned the growing apprehension about U.S. inflation. The Consumer Price Index in April jumped to 4.2% from March's 2.6%. Obviously, people are spending more, and the impact of those $1,400 checks that Biden sent out, plus the ultra-low interest rates in America, are causing consumers to go out and spend, and that's causing inflation to tick up. The unemployment level in America is again approaching full employment, more or less at the same sort of levels that it was before COVID began. But the Fed, the Federal Reserve Bank, and Joe Biden believe that inflation will return to around 2% in 2022. Of course, nothing destroys a bull trend like rising inflation, because then the Fed is forced to push interest rates up again. The market still believes the Fed and Biden's prediction, so they are also looking at a 2% inflation rate next year. We, on the other hand, believe that inflation in the US will probably stay high. Fears of rising inflation will ultimately cause this major correction that I'm speaking of, probably sometime in the next few months. But it will be a correction. It will not be the start of a new bear trend. So it will take us down 10 to 20%, and then the great bull market will resume, dragged up probably by quarterly results from the S&P 500 companies. So when that correction comes, you must treat it as a buying opportunity and look for those shares which you want to buy but couldn't afford previously. So that's what I have to say about America at this stage. Let's turn our attention now to South Africa. Of course, on the political front, Ace Magashule is predictably fighting back against his suspension. He made the absurd suggestion that he could suspend President Ramaphosa, but that was quickly debunked. And of course, it smacks of desperation. The removal of Ace Magashule is a major victory for Ramaphosa. It prevents Magashule from talking to ANC branches before the next ANC conference. Apparently, about 1/3 of the NEC supports Ace Magashule, which means that about 2/3 supports Ramaphosa. And that gives Ramaphosa a clear mandate for his reforms. But it may result in a split of the ANC in time. We believe, however, that the ANC will emerge from this stronger and more united. And that will be good for the share market, because the further economic policies are likely to be more sane than they have been. If we look at the economy, the Reserve Bank has increased its forecast for GDP growth for this year up to 4.2% from 3.8%. And that is significant because it means the economy is recovering much faster than was expected and as predicted. We suggested that the economy would recover faster, last year even. The Monetary Policy Committee has held rates at 3.5%, and they're expected to stay there for the rest of this year. And that, of course, puts money into the pockets of everyone with a mortgage bond. Goldman Sachs has recently made a very bullish prediction on the South African GDP growth. They suggest that it will be 4.5% this year. We've always said that the economy will bounce back faster than expected because there is substantial underutilized capacity in the economy following COVID-19 and the lockdowns. Goldman Sachs also says that inflation will peak at 5% and then trend downwards in this country. We, on the other hand, tend to feel that inflation, once it begins to rise, will rise steadily. Tito Mboweni, our Minister of Finance, has reported that government expenditure was 16 billion rand less than in the February budget. That's good news because it means the government deficit is now 11.2%. instead of the forecast 12.3%. The Reserve Bank is thus able to cut the weekly debt auctions by 900 million rand a week. That 900 million rand, of course, is then available for businesses to invest, which will boost the economy. The improved tax collections that we're seeing are a result of the commodity boom. Another sign of the rebound in the economy is the startling growth in car and truck sales since last year. April 2021 saw car sales just 2.7% lower than April 2019. And that, of course, was before COVID-19. And, of course, they are massively up from the miserable 574 cars which were sold in April 2020. This shows, perhaps better than other statistics, how the economy is recovering rapidly. All right, now let's take a look at the rand. It's important to keep your eye on the rand, especially if you're involved in rand hedge shares. Right, I'm going to put that 5-year chart on the screen that you're familiar with. In the last confidential report, we drew attention to the fact that international sentiment had shifted towards risk on following the Biden election. At the time that we made that suggestion, we saw that the rand was over here, just about at the 14 Rand 40 level where there's some resistance. This chart, of course, shows support at 1530 and resistance now at 1440. We suggested then, a month ago, that the rand would break down through that resistance level. And that is, in fact, what it has done. You can see here it broke down there and then went back up and tested the resistance level of 1440 again. In other words, the resistance became support, which is quite a common feature in technical analysis. When resistance gets broken, it becomes the support level. And then the rand strengthened further to reach all the way to 13.74 to the US dollar. We believe it will continue to strengthen over time. Whatever benefits emerging market currencies benefits the rand first, because we are the most fluid of the emerging market currencies and we are favored by international currency traders. Of course, the strengthening rand is not good for rand hedge shares. For example, PetroSA has taken an absolute pounding as the rand strengthened. In fact, we believe that it is now time to look again at PetroSA with the view to buying further into that share, because it's certainly come off quite a bit. You should watch closely for the best time to buy in. The stronger rand benefits the economy in a number of ways. Lower inflation, of course, is very important, as is improved consumer confidence. Ramaphosa is seen as winning the battle against Magashula, Zuma, and the others who support rapid economic transformation, which we all know is just a euphemism for rampant corruption. But the rand is volatile, so don't expect it to go in a straight line. It's subject to the whims of overseas investors and their shifts from risk off to risk on and back again. Let us now turn our attention to state-owned enterprises. The train derailment on the Richards Bay line, the latest one, shows that Transnet is still battling to control that situation and to manage it properly. They are plagued by vandalism and theft, which the police seem completely incapable of stopping. This, of course, prevents mining companies from getting their products to port and wastes the opportunity of higher commodity prices and, of course, reduces tax revenues. Transnet needs a top executive, like the one that Escom has now got, in order to control things and bring them back into perspective. Escom, of course, is in the middle of wage negotiations. It has 45,000 employees who are generally reckoned to be heavily overpaid. The unions are demanding a 15% rise across the board, which Escom have naturally rejected. Escom wants to completely restructure the conditions of service of its employees, so this is going to be quite an interesting battle. And of course, the negotiations have to be seen in the context of the wider negotiations of civil service unions with the government. But Eskom has managed to cut its debt by 83 billion rand this year, and it's cut costs by 13.5 billion rand, probably as a result of Andries de Ruyter's efforts, the new CEO. PetroSA is another state-owned enterprise which received 800 million rand as a rescue package from the government last year. PetroSA now say that they cannot pay their salaries in May. The board has been dissolved and workers have been given retrenchment notices. The gas-to-liquids refinery at Mossel Bay has stopped operating for some time now, and it looks like PetroSA will be forced into business rescue or liquidation without further government support. The post office is trying to insist that all parcels under 1 kilogram have to be transported through them. This will, of course, destroy the 20 billion rand industry which has grown up around their incompetence. Economic insanity, that's what this is. The post office has proved that they can't deliver parcels and letters on time, and there seems to be no point in trying to force the country to use them. This is similar to the efforts that Eskom made previously to prevent or slow down the independent power producers and to prevent outside generation of electricity, and also the SABC's attempt to get MultiChoice to collect their license fees. These defunct state-owned enterprises are doing everything they can to stay alive. The airports company is a nice change from this. They had their income cut from 3.5 billion in 2019 to just 685 million last year. In response, they cut costs, sold assets, and issued a preference share. They managed to cut their debt from 4 billion rand to 600 million and are confident of moving back towards profitability. This is one of the very few state-owned enterprises that can say that they are actually profitable or have the prospect of being profitable. They offer an example which Denel, the Post Office, the SABC and Eskom should follow. Right, I've got a few general points here which I'd like to make. First of all, our esteemed Minister of Trade, Industry and Competition, one Ibrahim Patel, has decided to change the Companies Act to address what he describes as the gross injustice of executive pay. Of course, South African companies compete internationally for executive talent. South African executives are paid at international rates. Otherwise, they would leave and go to companies or opportunities elsewhere. If they get paid less, then we will end up with poorer executives. Patel also says, mind you, that competitiveness and industrial agility are critical to the economy. It seems to us that he is a little confused. Obviously, if we lose our top executives, for whatever reason, we will become less competitive. Now, before the pandemic hit, illegal cigarettes made up 28% of total cigarette sales in South Africa. With the pandemic and the lockdown, cigarette sales were banned, legal cigarette sales. But illegal cigarette sales flourished. And they now comprise about 47% of all cigarette sales in the country. And people are not moving back from illegals to legals because, of course, of the huge taxes that they have to pay when buying a pack of cigarettes. With the ban on cigarettes, many smokers have decided that they're not going to go back. This, of course, is costing SARS a huge amount in lost tax revenue. Mr. Kieswetter has reported to Parliament that South African Revenue Service is rapidly improving tax collections. They have issued a number of civil and criminal actions. In many cases, have been handed over to the National Prosecuting Authority for prosecution. And they are also following up on the evidence given at the Zondo Commission, and they've been widening the tax base, which will provide the cash which we need to reduce the government debt. Okay, looking elsewhere, Gold Fields, the mining company, has announced that it is building a new 40-megawatt solar farm. This will provide about 20% of its electricity requirements. But what's interesting about this is that it will produce power for 47 cents per kilowatt. This compares to Escom's R1.66 per kilowatt. It also gives the mine more flexibility during power outages and reduces their carbon footprint by 100,000 tons per annum. Pan-African Resources, another mining company, is also building a solar farm. Clearly, Escom is pricing itself out of the market. Last month's confidential report showed a head and shoulders formation for Bitcoin. So let's have a look at Bitcoin, because I think this is quite important and quite instructive. Here you can see that head and shoulders formation that we spoke of. Over here is the left shoulder, right? Then there's the head and the right shoulder. Our confidential report was published over here, and we warned that this formation was coming and that it would probably break down through the neckline and then collapse, which is more or less what has happened. At the time that we issued that warning, Bitcoins were trading for $57,000. They're now down at $36,220. In our warning, we said, if you have it, sell it. If you don't have it, don't buy it. And we pointed out that Bitcoin cannot be analyzed fundamentally because it has no fundamentals. It's not like a company whose shares can be analyzed fundamentally by looking at the profitability of the company whose shares they are. You cannot do that with Bitcoin. So the only thing you can do with Bitcoin is to analyze it technically. And this head and shoulders formation is very important. The left shoulder is the smart money. It's caused by the smart money selling out while the market is still strong. So they want to sell into a strong upward trend. And they don't care if they don't sell out right at the top. They're quite happy to sell out 2/3 or 3/4 of the way up the trend. Then, once they've sold out, the bullish sentiment continues and the head is formed. After that, the market starts to fall. And then we get the stale bulls, people who still cannot get rid of the idea that this thing has got to go up. In the case of Bitcoin, there are people who sincerely believe that Bitcoin is going to go to $100,000 a coin. So they keep buying. They regarded Bitcoin as cheap over here when it was up there. So they buy. When their buying dries up and the market falls through the neckline, it tends to collapse. So that's what we've seen here. Of course, Bitcoin is very similar to gold because its value rests entirely on belief in its scarcity. Of course, gold is scarce because there's simply not a great deal of it. I mean, all the gold that's ever been mined since the beginning of history would not fill a cube 25 meters on a side. And that, of course, explains why gold has retained its purchasing power. In fact, gold would buy today the same number of chickens it would have bought in Egypt 5,000 years ago. So the purchasing power of gold has really not changed throughout civilized history. But the scarcity of Bitcoin is not like the scarcity of gold. It's not an established fact. In fact, the scarcity of Bitcoin is both arbitrary and man-made. So while almost everyone on the planet believes in the scarcity of gold, very few people believe in the scarcity of Bitcoin. And so because of that, it is very subject to volatility, to the emotions of fear and greed. And for that reason also, it can only be predicted really or analyzed by technical analysis. Okay, let's look at the companies now. First of all, I want to go to the JSE small cap. This is an index of the companies which are outside the top 60 companies on the JSE. In other words, they're small, too small to get into the top 60. I think I want to go to a 2-year chart. Here you can see the impact of COVID-19. And then you can see that the small caps kind of moved sideways for a while after that. But now they're in a strong upward trend. And this is what I really wanted to draw to your attention. They're probably outperforming blue chips and secondary shares now. And that is something worth paying attention to. So shares in the small cap index include companies like Hudeco, Libstar, Consolidated Motor Holdings, CMH, and also Long for Life. So we suggest that you look at some of those shares with a view to picking up the ones that are going to perform well. Let us take a look at Long for Life, because that's a share which I think is worth looking at the moment. Long for Life, of course, was started by Brian Joffe of Bidvest fame, and it has a bunch of retail assets which it owns. And it's generally been trading since it listed at below its net asset value. In fact, the net asset value now is approaching 7 Rand a share, and the share is trading for 474 cents. So it's a significant discount, about a 30% discount to its net asset value. They've tried a lot of things to overcome this discount, such as buying their own shares back and so on. But now they've engaged a third-party company who have expertise in this, and whose job is to review and close this gap if they can. And we can see here that there's a strong upward trend developing in Long for Life. So it's a share which I think you could make a bit of money out of. Now last month we showed the relative strength of MTN against Vodacom, and we drew your attention to the fact that MTN has been outperforming Vodacom for some time, and we suggested that it would continue to do so. So if I can just put a chart on here, you can see there the top chart here is MTN's candlestick chart, and the chart below here is the relative strength to Vodacom. And as you can see, it's been trending up very steadily between an upper and lower channel line. Now, when we spoke about that last month, MTN was trading for 88 Rand and 79 cents. It's moved up now to about 104 Rand. And it's gained about 15.4% in just over a month. So there was a share that was definitely worth a look. All right, let's look at Murray & Roberts. Murray & Roberts, obviously a big construction firm. And what's interesting about this company is that they've been winning contracts in Australia. So let's put a bit more data on the screen here. You can see Murray & Roberts, like all the construction index firms, the big companies, went through a terrible time where the shares just fell and fell and fell, culminated last year with COVID. But since then, it's been moving up. We always suggested that you should wait until it broke up through its long-term downward trend line. That happened in January this year, early January this year, at a price of 809 cents per share. It's now at 10 Rand 20, so it's gained 26% since that time. The next share I want to talk about is Massmart. Massmart, obviously bought out by Walmart in 2014, and they brought in a new guy, Mitchell Slope, to try and turn the company around. You can see here, wait a minute, let me just put that a little bit wider. We wrote an article about Massmart on the 4th of September last year, 2020. And the reason we wrote the article was because Mitchell Slope, this new whiz kid who's been brought in from Walmart as a turnaround artist, had himself, in his own name, bought 300,000 shares of Massmart at around 27 Rand a share. So when we wrote the article, the share had gone up to 31.50, and we suggested that it was potentially a good buy. Now, 8 months later, the share is trading for 65 Rand or 64.76, which is a gain of 105% in 8 months. Not a bad return if you followed our advice. Let's talk about Tiger. Tiger, of course, Tiger Brands is a big food company, a massive food company. They are well known for having been involved in the listeriosis crisis, which occurred in 2018. And what is interesting about this company is the head and shoulders formation that occurred just before the listeriosis crisis. So there's your right shoulder, your head, your left shoulder, and then the market breaks down through the neckline and down it goes. This head and shoulders formation implies that somebody inside Tiger Brands, some big shareholder inside Tiger Brands, must have known what was coming, and they started offloading their shares, causing this head and shoulders formation well before the market knew what was going on. We always advised, once this had happened, once the listeriosis crisis broke, we said to you, apply a 250-day moving average and wait for a clear buy signal. That buy signal came on the 28th of September 2020 at 186 Rand. Since then, the shares moved up to 223, which is a nice gain of more than 20%. Sappi. Sappi is a producer of dissolving wood pulp and other biomaterials. These things are used to manufacture clothing, packaging materials, and paper and other things like that. They have been battling with low demand over a long period of time, and the share price has been falling ever since it did this triple top. Can you see this triple top here on the chart? I've highlighted it with the 3 green arrows. A triple top, when it fails at the third top, is very, very bearish. And what followed there was a strong downward trend line. Again, we suggested that you put the trend line on and wait for a convincing upside break through it. There you can see the impact of COVID-19. And finally, the upside break, which came over here on the 10th of November at 26.93 cents. Since then, the share has moved up to 44.65, and that's a gain of 65.5% over a period of about 6 months. So that's quite a nice gain there. Another company which we really like is the Lewis Group. Lewis is a low-end furniture manufacturer and retailer, well, mainly a retailer, and we've liked this share for a long time. One of the reasons we really like it is because they have a completely ungeared balance sheet. In other words, the company has no debt at all, and that gives it enormous flexibility. It enables it to take up acquisitions and other opportunities when they arise, and to avoid any kind of pressure on its cash flow. So we like Lewis. In their results for the year to the 31st of March 2021, they said headline earnings per share grew by 136%. That's massive. And the company is growing both organically and by acquisition. On the 27th of May, and that's what we wanted to draw your attention to. You see the 27th of May here where I'm pointing. There was 1.5 billion rands worth of shares that changed hands. Clearly, the big institutions are now getting into the share, and that, of course, gave us an on-balance volume buy signal. You can see the spike up here. And we believe this share is going to perform from now on. So the big institutions are getting involved, and it's probably not going to sit at these levels for very long. Ladies and gentlemen, that's basically what I have for you this month, and I hope that you found something of interest and of value. I will be speaking again on the first Wednesday of next month, so I look forward to talking to you then. Thank you for listening.